But some of the Wall Street Bets posts celebrating that Melvin Capital finally shutting down. I mean, it's been a rough time for some of those retail stocks, those retail favorites that they've liked. I mean, some of those speculative stocks getting a bid today, but it's been a really tough go.
Yeah, Katie, I'm glad you brought that up. It's something that we talked about earlier on Quick Take Stock with Bailey Lipschultz, the idea that these folks who are celebrating the demise of a hedge fund, well, if you are a day trader, if you got into the markets in the last couple of years as part of this retail trading revolution, it's been a really tough few months since the decline of some of those high-flying stocks. Well, that is going to do it for now. We are going to be back together again live on TV and radio and on YouTube at 4 p.m. It's for our Beyond the Bell coverage when we take you through today's market close.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld. We're live in the Bloomberg Interactive Brokers studios here in New York. Katie, I'm so glad just now in our simulcast chat with our friends at Bloomberg TV, Caroline, Taylor, and Shanali, you talked about the idea of a self-fulfilling prophecy when it comes to a recession.
Oh,
it does, yeah. I mean, it does feel like to you, because you said this, that people could will this in. But I think there is a lot to be said about the way that sentiment changes when people start to hear about financial conditions tightening and people also see what's going on in the stock market. Caroline referenced some data about the way that spending changes when people do see their investments go down. But I wonder if there's more of an effect based on the way consumers are feeling about the health of the overall economy. If they're hearing we could be in a recession, we could see a recession in the next 12 to 18 months over and over again, how does that affect their spending?
Well, think about also why the Fed cares so much about inflation expectations. It's because your expectations of something, it affects how you behave in the economy, how you spend. So if you see inflation expectations become unmoored, that's when maybe you pull back some of that spending. I mean, that psychology of how this feeds into the markets, this is all stuff that the Fed really monitors because this is how human psychology works, how behavior works.
Can you talk a little bit about, just in the last 30 seconds that we have right now, a little bit about financial conditions? It's something that you write about all the time in terms of how the Fed is thinking about what it does when it comes to monetary policy.
I mean, part of the reason why the Fed is able to look past what's happening in the markets right now is because financial conditions, they're tightening, but they're still not at really, really restrictive levels. And that's how this whole thing that we're doing, this monetary tightening, it touches the real economy. That's how it's felt. And we're not yet at really, really restrictive levels. Stock
market higher is not part of the Fed's dual mandate.
No, unfortunately.
Well, you know what? They've got the dual mandate and they've got to stick to it. Let's get to world and national news. For that, we turn to Nancy Lyons. She's in Washington, D.C. Hey, Nance.
Thanks, Tim. The Senate has approved a new $40 billion aid package for Ukraine.
The yeas are 86, the nays are 11, and the bill is passed.
The House approved the measure last week. President Biden now is expected to sign it. Well, President Biden has been hosting the leaders of Sweden and Finland at the White House today as they discuss their intention to join NATO due to Russia's invasion of Ukraine. President Biden calls both countries among our strongest partners on a range of issues and commends their decision to join the defensive alliance.
Standing together today, we reject the bloody creed that might makes right, and we declare a more powerful creed, all for one and one for all.
Biden and the two prospective members must first broker an agreement with Turkey, which blocked their formal NATO application for moving forward due to concerns they support Kurdish militias. Biden is now heading on a 6-day trip to South Korea and Japan, with trade expected to be part of those talks. Pollution from rockets built by SpaceX, Blue Origin, and Virgin Galactic could damage the Earth's climate and harm people's wealth. Research published in the Physics of Fluids indicates the nitrogen oxides released by an ascending rocket are considered hazardous to health, as determined by the World Health Organization. At the PGA Championship at Southern Hills Country Club in Tulsa, Rory McIlroy is leading at 5 under par. Tiger Woods is tied at 87th at 4 over. Stay tuned to Bloomberg for hourly golf updates and full play-by-play coming up after the markets close on Bloomberg Radio. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much for that update, Nancy Lyons, Tim Stenovic, and Katie Greifeld. We're live in the Bloomberg Interactive Brokers studios in New York. Katie, how has it been an hour and 11 minutes and we haven't talked about Twitter yet?
I was getting a little bit nervous, when are
Don't
we going
worry.
to get there? And here we are.
Here we are. The news continues. This latest story is about whether or not the deal is proceeding. And guess what? It is, at least according to Twitter executives. They told employees today that the $44 billion deal to sell the company to Elon Musk, the billionaire, is moving forward as planned, and that they will not renegotiate the agreed upon price of $54.20 per share that values Twitter at about $44 billion.
That's big news that they won't renegotiate that price because that's been a question mark. And you saw Twitter's top lawyer and head of policy push back on claims from Elon Musk saying that he's pausing the deal while he learns more about the number of bots and spam accounts on Twitter. So a bit of back and forth that we're watching play out here, Tim.
Twitter stock did jump earlier on the news. The meeting, it was first reported by Bloomberg. Earlier, the shares had declined as much as 1.7%. Other top Twitter executives, including CEO Parag Agrawal and the finance chief Ned Siegel, they also addressed employees, said the people who asked not to be identified, discussing internal business. The company-wide video call was not intended for leadership to discuss the deal and provide more details following Twitter's filing of its proxy statement with the SEC earlier this week that did outline the transaction's history and terms. Musk had earlier this week suggested that he would be interested in renegotiating his deal for Twitter. The company's stock is currently trading, well, I'm going to pull it up here on the Bloomberg, but it's a far cry, Katie, from the $54.20. It's $37.70 that right now values the company at about $28.8 billion.
Can you imagine being a Twitter employee watching this play out?
No.
No.
I mean, it's like so much uncertainty, right?
I know. And so this is the latest in a string of internal meetings intended to help employees better understand the sales process. Would imagine that's a lot of meetings.
Hey, a headline just now, some breaking news crossing the Bloomberg terminal. We call them red stickies here. The Trudeau government said to ban Huawei from 5G in Canada. This some breaking news about Canada and Huawei. The Trudeau government said to ban Huawei from 5G in Canada. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters. I'm Charlie Pellet. U.S. stocks continue to trade mixed, but repeating an earlier headline, the Trudeau government is set to ban Huawei from 5G in Canada. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks well off of session lows, but in a choppy session. Dow's currently down 71 points, was down 474. S&P's higher by a point, while NASDAQ climbs by 56. The U.S. 10-year yield at 2.85%. Gold is up 24. Oil is climbing. And Bitcoin is up by 3.4%. Among the main 11 S&P sectors, leaders were materials and consumer discretionary. Consumer staples and financials were under pressure. And leaders to the upside in the Dow, Home Depot, UNH, and Boeing, while Cisco plunged 13% after earnings and led to the downside. In other news, Twitter spiked intraday. Executives said the Twitter deal is proceeding and not on hold. And Harley-Davidson fell 8% on news it was halting shipments for 2 weeks. Wrapping things up, Palo Alto Networks reports after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, thank you, Bill. To hear live breaking news over your Bloomberg, type Squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, it's been a whirlwind few days for my co-host of Bloomberg Business Week, Carol Massar. She's been in Panama at the Bloomberg New Economy Gateway Latin America Conference. She joins us now live from Panama as the conference gets wrapped up. Carol, how has it been these last couple of days?
It's been really busy and a lot of conversations, Tim, with the right people about some of our major global issues, things that you and Katie have been talking about throughout the day. And earlier, I hosted a panel. It was all about the threat of global food shortages. Obviously very serious, and we see the higher prices and we see shortages around the world. I caught up with Enrique Lopez Lacube. He's Chief Financial Officer at Biocetis Crop Solutions. They're a biotech firm, bioengineering. Earther & Cousins, CEO at Food Systems for the Future over at Stanford, former Executive Director of the World Food Program. Marcela Escobari, Assistant Administrator of USAID's Bureau for Latin America and the Caribbean. And then also Mauricio Rodriguez, President for the Crop Science Division in Latin America at Bayer. And so we had public-private sector points of view. In this excerpt, we kicked off the conversation talking about, are we indeed in a global food crisis?
I call it a looming food crisis. Looming, we're on the verge. We can avoid it. The challenge is, however, that when we talk about a looming global food crisis, but the specific, I should say, for those who are acutely hungry, where 50% of WFP's food comes from Ukraine, and the increase in the cost of humanitarian response has resulted in a limited access to enough food to feed those who were already in a crisis situation. That humanitarian challenge is happening as we speak. Now, the question is, will that challenge become larger, affecting more people? And that's why I say a looming food crisis based upon the high price of fertilizer, the crisis in Ukraine, of course, with the reduction of food in the global system, the impacts of India's recent export control that they placed on, because India had indeed increased the amount of food that they were releasing into the food system to help with the loss, and then they pulled back because of the heat crisis and their challenges with their own crops that are in the ground right now and the reduction that they're already seeing because of that heat challenge on their anticipated harvest.
All right, so let's bring up the poll results if we can, because again, what percentage of the world lives with moderate or severe food security? I'm curious what you all said. And 75%. Well, good news is it's not that bad. Yes. It's 30%, and that's what the UN has found. And it's been growing, though, over the past 6 years. So we're not figuring out better ways to do it. You know, it's interesting. There was a Bloomberg opinion columnist that put out a story, and it just talked about how we've doubled the population in, like, the past 50 years. And we've been able to feed most people because of globalization. Enrique, come in on this conversation. Is globalization, as we turn back from it, is that going to fail? Our inability to continue to embrace it, is that just going to exacerbate the problem? It seems like it is already.
Yeah, I think it is something that we need to keep embracing from a food security perspective. All of the supply chains that have been put together by the private sector, all of the regulatory frameworks on the global trade, that has been built preaching on globalization. And I think that it would be very, very hard for the world to go back to a non-globalized supply chain when it comes to commodities, mainly. When you look at what's happening with grain as a commodity is a global supply chain and a global business. And the companies that operate in different countries are the same companies. So if you look at who's operating in Brazil, the US, Canada, Argentina, to make a reference to the Americas, those are the same companies. And their business is built based on globalization and global trade. So I think it would be very, very hard to basically build again something that doesn't count on globalization.
Marcella, we shouldn't be surprised that we're here?
Should we be surprised that we're here?
The stresses.
No, as we know, this is this looming crisis and insecurity, food insecurity, particularly in this hemisphere, has been worsening even before the pandemic. And just the pandemic and obviously the war in Ukraine have only aggravated it. And as Ethel said, this is a triple whammy, right? Food, fuel, funding, three things that are hitting the region in full force. And I would say climate change, even though it doesn't start with an F, is also something that's affecting the food crisis.
And that last voice was Marcela Escobar of USAID's Bureau for Latin America and the Caribbean. You can catch more of this conversation from Bloomberg New Economy Gateway Latin America. You can catch that on Bloomberg Business Week on Saturday on Bloomberg Radio at 8 a.m. So more of that conversation. You know, what's interesting, you guys, I bet you've been talking about this story. It's among the most read on the Bloomberg about our economics team cutting GDP, global GDP for 2022 by $1.6 trillion. The concern is the ties that bind us globally. We're talking about globalization. They are unraveling at a really fast pace. And that's going to have implications. We've seen it already, right, in terms of our global supply chain, but also for our global food supplies. And so really troubling, and it has some pretty huge implications.
Yeah, so many things coming to a head right now. Of course, Russia's invasion of Ukraine, spiking commodities prices, China's COVID-0 lockdown, all of that sort of being this tinderbox that is really increasingly leading to scarcity in many parts of the globe. Carol Masser, live from Panama City in Panama, wrapping up the Bloomberg New Economy Forum there. Carol, we wish you safe travels back. We look forward to having you back in the office next week. You're listening to Bloomberg Business Week, and this is Bloomberg Radio.
broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld. We're live in the Bloomberg Interactive Broker Studio in New York. I'm using the WEI function on the Bloomberg terminal to pull up world equity indexes, and the S&P 500 is lower by 0.4%, while the Dow lower by 0.6%. The reason I bring this up is because it's been a really choppy day, and if you were to have just looked at this earlier in the day, you'd think we were headed for another sell-off like we saw yesterday, but stocks have bounced back, although now they're hitting in the negative territory again. We're going to talk all about this with Abigail Doolittle in just a few minutes. But first, more details on today's market action. Here's Charlie Pellet.
Thank you very much. The Dow, the S&P, NASDAQ, all in the red, Tim, as you correctly point out, with the S&P down 17 now, down 0.4%. The Dow lower by 195 points, down by 0.6%. NASDAQ down 7, lower little change, down by less than 0.1%. Ongoing theme, traders continue to weigh prospects for growth against a backdrop of rising prices, eroding earnings, and tightening monetary policy. We've got the 10-year up 12.30 seconds. 10-year yield right now 2.84%. Spot gold up 1.4%, up $25 the ounce to $18.41. West Texas Intermediate crude up 2.1%, $111.85 a barrel on WTI. Legislation that would allow the president to bar selling gasoline at so-called excessive prices has passed in the House as Democrats seek to address record-high prices at the pump. The bill is not expected to muster the Republican support needed in the Senate. Still, it will give Democrats a talking point as they return home for a 2-week recess, with the average price of a gallon of regular unleaded gasoline setting a new record every day for the past 10 days. Energy stocks trading mixed right now. ExxonMobil, for example, up 0.8%, but BP giving up earlier gains, down by 0.1%. Chevron now lower by 0.4%. EOG Resources down 0.1%. Pioneer Natural lower by 1.8%. Again, recapping, stocks lower, S&P down 19, lower by 0.5%. After the bell, among the companies reporting, Applied Materials. I'm Charlie Pellet. That's a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, as I mentioned, if you were to just look at what was happening early in the session and before the markets opened this morning, when you were looking at what was happening, it seemed like we'd be headed for another sell-off today, but that's not necessarily what's going on. You just heard the numbers there from Charlie Pellet, but they bear repeating. The Dow Jones down by 0.7%, the S&P 500 down 0.5 percentage point, the NASDAQ down by just 0.1%. I say just because in a market, Abigail Doolittle, where we have seen outsized moves over the last few months, it does feel like today's trade is really struggling for direction.
It does, and I love this headline that's here on the Bloomberg terminal: stocks swing lower in seesaw session. And about 10 minutes ago...
Say that 10 times fast.
Yeah,
or just 3 times fast.
But 10 minutes ago, it would have been stock swing higher in seesaw session. So that's the up and down that we're seeing today, but relatively small moves. On the open, you had stocks down more than 1%. Then you had the NASDAQ up basically 1%, searching for direction, as you said. And this is what we've seen over the last couple of days. We're still above last week's low, which suggests that maybe investors are trying to build this into some kind of a bounce.
Even with yesterday's sell-off, we're above last week's low?
Yes,
wow.
Which is pretty amazing. So it suggests that you could still have some kind of bear market rally, but that it's not going to be just like a straight up, that it's going to be some sort of uneven, unpredictable action, which we are, quite frankly, seeing. I mean, investors have so much to contend with between inflation, the Fed, earnings, the corporate profit outlook.
The list goes on.
What else?
Yeah, the list goes on and on.
But with all of that, all those different headwinds, all those different inputs, a lot of people that I've been speaking to, at least, seem surprised that you just have the VIX just at 30.
Well, that's the thing that makes it seem that we really could have some kind of real bounce, because you know, it's interesting. Kevin Kelly of Kelly ETFs, he's one of our experts who joins us on Options Insight. He talks about how the VIX is actually not a fear index. It measures uncertainty, whereas the skew index is the panic index. That's the one that really measures fear.
So are we panicking?
More so. We're not. The skew is actually at record lows. So that's something to think about. So the options market really not pricing in any sort of real fear, panic, even uncertainty at this point. I mean, I guess the VIX from a historic standpoint, if you go back years and years, anywhere between 20 and 30 was a healthy amount of hedging a non-complacent market. But then we got used to like sub 15, a 10 handle, and so the 30 seems a little bit higher. But nonetheless, it supports the idea that, again, there could be some sort of a bounce within the context of this downtrend.
But a bounce doesn't necessarily say that we've reached bottom already. And from a technical standpoint, what are you looking at?
So from a technical standpoint, the S&P 500, in my mind, undoubtedly at some point this year will probably go to what Mike Wilson's talking about, 3,400. And sometimes you can see an overshoot. What's so interesting right now, based on some of the analysts and the strategists on the street, a lot of them are talking about how in the near term we could have some pain, but later this year there's going to be some reprieve or a year-end rally. I'm not so sure that that is what some of the signals that I'm watching and hearing about are suggesting. Instead, I actually think that we could have some sort of reprieve in the near term, call it the next month to 2 months, 3 months, from the the big decline, the almost 20% down that we've had in the S&P 500, and then at some point later this year, maybe a couple of those, something deeper. Whether or not a move to the downside toward that 3,400, if at some point it went the stairs, what is the phrase? The stairs up, the escalator down, whether it's the elevator down, whether it's the elevator down, because this time period is starting to really remind me, and I'm dating myself, of 2000 to 2003 and 2008. So in 2000 and 2003, it would go down 20%, up 20%, down, and I wouldn't be surprised if we see something like that long rolling bear market.
A long rolling bear market.
It's so interesting.
Not the most encouraging message.
Well, it's interesting. I caught a little bit of surveillance this morning, and I heard John Authors make a similar point.
Oh, really?
Yeah, about 2008, and seeing some signals now that he saw back then.
Well, 2008, right in January this year, reminded me of 2008 just for the volatility alone. Because if you remember, the first week of January, we were off to the races. We were higher, higher, higher. It was all about that value was going to catch up. Now, value has caught up, but not for the reasons that people thought in that first year. But there were, big declines from there on out. Right now, we're looking at the 7th down week for the S&P 500. That's the worst since 2001.
Wow.
So you have the volatility of 2008. But even in that year, it was a similar situation where you had a couple brutal down months, then a little bit of a reprieve, and then sort of flat to down, and then the floor fell out. The question here is, will you have the floor fall out like that, or in 2000 to 2003, just a steady downward trajectory with intermediary rallies? The one thing I would say is, yesterday on the train ride home, I actually recently moved to Westchester, so I'm taking...
Congratulations.
Thank you. I love it, and I actually love the train rides. On the way in, it's a nice chance to think and meditate and that sort of thing. On the way home, I basically fall asleep, but last night I heard a trader in the next seat. So there were 3 or 4 guys, and each of them took a turn talking about like whatever their expertise was. And the one guy, well, what about stocks? They didn't do so well today. So the trader talked about what he was thinking, and he was saying it was the most orderly sell-off that he had seen.
All right, even working on the way home, Abigail Doolittle, markets reporter for Bloomberg News, with us in the Bloomberg Interactive Broker Studios. To Washington, D.C., we go for a check of latest world and national news. Hey, Nance.
Thanks, Tim. President Biden is heading off on a 6-day tour of South Korea and Japan to discuss trade and other issues. But before leaving, he cheered the bids by Finland and Sweden to join NATO after meeting with the leaders of the 2 European allies at the White House today.
Finland and Sweden make NATO stronger. Not just because of their capacity, but they're strong, strong democracies.
Biden says a strong NATO alliance is needed now more than ever. Another infusion of aid is heading for Ukraine. The Senate today approved a $40 billion military and economic aid package, which now goes to President Biden's desk. The head of the FDA has been taking questions today from congressional lawmakers on the shortage of baby formula that has rattled American parents. Robert Califf placed some of the blame on the production issues at a lab producing the formula.
This crisis has shown us the impact of having a single manufacturer cease production for a brief period. And unless we strengthen the resilience of our supply chain, we could be one natural disaster, quality mishap, or cyber attack from being here again.
FDA Commissioner Robert Califf, President Biden has invoked the Defense Production Act to speed up domestic manufacturing. He's also authorized flights to help import formula from overseas. At the PGA Championship today at Southern Hills Country Club in Tulsa, Rory McIlroy is the leader at 5 under. Tiger Woods, he is tied in 102nd place at 4 over. Stay tuned to Bloomberg for hourly golf updates and full play-by-play coming up after the markets close here on Bloomberg Radio. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
Thank you so much to Nancy Lyons in our DC studios for that world and national news update. Tim Stanovic and Katie Greifeld were live in the Bloomberg Interactive Brokers studios in New York. Katie, you and I were talking about this story a lot today on our Quick Take show. Quick Take stock, it airs each day at noon, Wall Street time on Bloomberg Quick Take. Gabe Plotkin's Melvin Capital Management, Hema Parmar, our colleague, she was actually on the air with us yesterday, had a scoop last night that Melvin Capital Management is shutting down after a tumultuous year. And the second day story that I find really interesting here is it was central to the rise of retail traders and the Wall Street Bet story because Redditors really went after him.
They did, and I mean, definitely a celebratory bent to what you're seeing on the forums today. I love that our personal finance team found probably the most, sanitized versions that they could put into a story.
Yeah, I mean, there's you don't want to spend too much time on these, in these forums online. It gets ugly pretty quickly.
It does get ugly pretty quickly, but I mean, this really goes back to sort of, it was a kind of reading this was a little bit deja vu to thinking about when this was going on, January and February of 2021, I believe that this was the narrative, that it's us against the big guys. It's us, against these hedge funds. So it makes sense that, all these months later that finally they're taking a victory lap here.
Yeah, so let's go into some details about what we learned yesterday. Gabe Plotkin is shutting down a $7.8 billion hedge fund. And as you mentioned, Katie, it was met with celebration on the forums that fueled the initial revolt against his short positions in GameStop and other troubled companies that became the favorite meme stocks of 2021. You'll recall at that time an army of traders on Reddit's Wall Street Bets targeted Melvin and other hedge funds, which they argued were a manifestation of Wall Street's greed. Something you and I talked about earlier in the day was that a lot of these day traders who are probably celebrating the demise are probably pretty significantly underwater given the way that some of these high-flying stocks have pulled back in recent months. Check the story out on the Bloomberg. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell. Stocks lower across the board. Choppy day. We have got the S&P down 20 right now, lower by 0.5%. Just a minute ago, NASDAQ was higher. Now it is down 14 points, down by 0.1%. The Dow down 233, lower by 0.7%. Traders continue to weigh prospects for growth against a backdrop of rising prices, eroding earnings, and tightening monetary policy. Right now, we have got the 10-year yielding 2.85%. Spot gold up 1.4%, now up $26 the ounce to $18.42. West Texas Intermediate crude up 1.9%, $111.64 for WTI. Briefly, Spirit Airlines has rejected a hostile $3.3 billion takeover offer from JetBlue, setting the stage for a potentially contentious vote by shareholders on whether to back the bid or go with a competing proposal from Frontier Group Holdings. Shares of Spirit, they are down 1.2%. JetBlue up 3.5%, and Frontier up by 1.1%. And that's a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Well, it's hard to believe we are already there, just 10 minutes away from the close of trading here in New York City. The Dow lower by 0.6%, the S&P 500 by 0.4%, the NASDAQ. We can go ahead and call that flat, though it is down 2.75 points, just 0.03%. Let's get into it. Kathy Entwistle is a managing director at Morgan Stanley. She joins us on the phone from Miami. Kathy, how are things?
Things are volatile. They are uncertain. It's giving everybody a little bit of uneasiness and a lot of people asking what to do in these markets.
Finally, an honest answer when I ask how you're doing, because I ask people all the time, and I'm like, are you kidding? Look at these markets. How are you feeling? Okay. Thank you, Kathy.
You ended on a great question. I want to ask you that. What do you do in these markets? Do you hide out, or are you looking for opportunities amid some of the sell-off here?
I would say a little bit of both. So for the last 6 months or so, our firm has been cautioning against, exactly what's happening now. So we've been helping clients move out of growth and into value and trying to reset portfolios where we can, take advantage of volatility and take things that are painful and turn them into potential opportunities by booking losses for things that we don't think will recover as well and putting that money into areas that we like. One area that surprisingly I've been putting money in for clients over the last 6 or 8 weeks is municipal bonds, which seems very straightforward, very boring.
I wasn't going to say it.
I think they're interesting. I think munis are interesting. Why?
Munis have not been interesting for 2 or 3 years. We have not put new money into munis in years, and now there's an opportunity. There was a dislocation, and they're more attractive.
What's attractive to you about them?
Well, first of all, munis are down, right? They're down year to date, and so they're cheaper, so the yields are a little bit better. And we're looking at clients, individual clients, particularly with their wealth, and trying to protect it and also give them some tax-free benefits, whether that's managing it from tax harvesting or giving them investments that will provide, tax havens. And munis are one of those.
Okay, I remain unconvinced that munis are exciting, but what I do find exciting is...
I appreciate your honesty.
Of course, we're just being very, very honest in this segment.
I never said they were exciting. exciting. I never said they were exciting. It's just a good option right now.
Okay, fair enough. But I do want to get your thoughts on the U.S. Treasury market because obviously, I mean, we saw long end yields really back up, cooling off a little bit now, that sell-off. What are you thinking there?
Well, we think that actually treasuries are probably the most fairly priced investments in the market today. And we also do think that there is an opportunity to buy treasuries and hold them for a little bit, and we should see a bump in them. So we think that's a buy right now.
Any part of the curve, what are you thinking on duration risk here?
So for duration risk, we're thinking more actually to go a little bit long because of the pricing of where it's at right now. You can go long, and we think there might be a little bit of a pullback there, which would give it a boost.
Interesting. Okay, so we've talked munis, we've talked treasuries. Let's get back to equities here and talk about potential downside and when you and the firm see the bottom here.
All right, so that's a great question, and it's definitely tricky. I like to follow Mike Wilson at our firm and Lisa Shallett. I think they're both brilliant. In fact, I'm down in Miami with Lisa Shallett, and I just heard her speak about her thoughts. But, you know, what we're trying to tell clients is this is it is a little bit different, right? So in the past, buy on the dips, long-term holds, like these, you know, there a lot of things that used to work might not work right now. And also, I'm telling my clients to be patient. I'm also looking at opportunities to trade out of those companies that we think might not do well going forward. And so, for example, maybe there's some technology names that have run up, or there's areas of the market that have run up, the growth areas, and it might be a better opportunity to trade out where you can when the markets have a pop into things that we think have a longer term view. So
what are those things?
They might include financials, healthcare, utilities, energy, just areas that you might expect that would do well in a rising interest rate environment.
And I mean, I'm curious to get your thoughts on staples in particular, because I was looking at a chart earlier this week that if you compare staples to, consumer discretionary stocks, for example, staples have really been the shining star in that sort of sector breakdown. What are your thoughts on staples at this moment?
Okay, so we're talking about individual company staples versus consumer staples. Correct?
Consumer staples, I should clarify.
Oh, consumer staples. Okay, great. Thank you. So we have liked staples much more than discretionary, and we've been very verbal about that in terms of that's an area that, listen, customers or clients, individuals, they're starting to pull back. They're feeling the heat of a rising, interest rate market and also inflation. Things are more expensive. We're starting to see the consumer start to pull back. They still have to buy toilet paper, toothpaste, and things like that. So staples can't go away.
Right.
Discretionary can.
Right. And I mean, Kathy, we're coming off of a very dramatic earnings season. It's not over yet, I hear. I don't know, if you think about what we're hearing from the retailers in particular, it felt like for so long margins, at least on the S&P 500, sort of the big index level, they were just Teflon. They just were not getting dented at all. Has that narrative started to change?
Yes, it definitely has changed. We don't expect companies to be able to kick out the profits that they were kicking out previously because there's a lot of unknowns that are hitting their bottom line, which includes rising interest rates, which would mean that the cost of borrowing has gone up, supply chain issues. And it's a question of, are they going to pass this off to the consumer, or are they going to take the hit in their own bottom line? And I think they have to take the hit in their own bottom line for the most part because the consumer is not willing to pay those dollars anymore. They're worried and they're sort of closing in. So the PE or the earnings that the companies are going to display going forward should probably be reduced from what we were expecting, and then that brings the price of the stock down and also the PE down. And so bottom line, when they get to a certain point, in like the S&P 500 per se, we think at that point they're going to have more like, a 16, 17 PE ratio. That seems a lot more reasonable than the numbers that we've been seeing in the 20s lately.
Kathy Entwistle, Managing Director at Morgan Stanley, joining us live from Miami. Kathy, thanks so much for taking the time. We are just a couple of minutes from the close of trading here on this Thursday afternoon. At the latest, the Dow Jones Industrial Average down 211 points, or 0.7%. The S&P 500 trading at just about 3,900. That's down 0.5% right now, 21 points. The NASDAQ down 0.25%. Coming up next, it's Beyond the Bell, our cross-platform coverage of the market close with our colleagues from Bloomberg Television. This is Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And we are just about 2 minutes away from the end of the trading day. Taylor Riggs, Sonali Basak, Caroline Hyde, of course, still out there in Panama, counting you down to the closing bell. And here to help take us beyond the bell with the global simulcast, we are joined now by Tim Stenovic and Katie Greifeld, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the day. And Tim, the crucial moment for me is another day of some downside, 3,900 on the S&P.
Yeah, it's really interesting that you say that. We just had Kathy Entwistle from Morgan Stanley on the program, and I asked her, okay, Kathy, when is the bottom here? And she gave a shout out to her colleagues, Mike Wilson and Lisa Shallett. Wilson specifically saying that as potential downside, we could see 3,400, as we know, but that doesn't mean there aren't opportunities right now. She's telling her clients to potentially move out of, those higher growth names and instead move into opportunities like utilities, healthcare, energy, and financials.
And staples, still a bright spot, as you think about what people need in this high inflation environment, sort of the spending that they can't shift. So staples obviously have been an outperformer. Yeah, some of the shine coming off in the past few days, though.
But still, again, it seems to be the consumer front and center as to how much we're really seeing them weather this inflationary push. And the companies that can't pass it along, Kroger's yet again another key name that seems to be under pressure as they stomach some of this cost price inflation.
I think one of the questions here is what other hiccups might we head into the end of the year? To your point on the low, Tim, we just had iCapital's Anastasia Amoroso on. Her low is 3,100, but there's a lot of factors that would need to happen to get there.
Yeah, certainly a lot of calls. It was BTIG as well, saying that we actually have more conviction to get to 34, 3,500 than we do to get a rally up to 42. So certainly a lot of commentary, Tim, as we think about heading down here to the downside as well. I think what's interesting, and I want you guys to pull up on your terminal here the 2-day soups here, because I know yesterday we talked a lot about the size and the scope and some of the biggest big drawdowns that we had going back since June of 2020. Today definitely feels less dramatic, but I wonder on a 2-day perspective how big we really are thinking about some of this drawdown, Tim. We are off about 0.8% on the Dow, 0.6% on an S&P 500, very round number here at 3,900, and a NASDAQ, the mild outperformer, down, I should say, about 0.25%. Take a look at this, Tim, the Russell 2000, unch to green.
Well, let's still call it green, right? Even though it's unchanged, we can still call it green. It's interesting, Taylor. It's a decline, yes, overall, but not even close to as broad-based as yesterday, where we had all 30 stocks in the Dow lower and only single-digit number of stocks in the S&P 500 that were higher yesterday. It's kind of half and half. 225 advanced on the S&P 500, 279 were declined today. On the Dow, we saw 24 lower and 6 higher.
Tim, you really see that, right? On an individual sector level, two sort of levels down within the S&P 500. We actually have a little bit of green on the screen today, unlike yesterday, Tim. So I do this for you. Some of this feels risk on. Materials are up about 0.8%. It's hardware, equipment, right, and services. So that certainly catches a little bit of a bit as you think about some of the risk on sentiment underneath the surface. I have to say, Tim, this is so surprising. Katie, I'll bring you in here as well. Food and staples, food and beverage, consumer durables. Those are some of the worst sectors again on the day. You're off about 2%.
It is interesting to sort of see some of the consumer staples weakness get carried through. But let's talk about some gainers, because I'm going to start with Synopsys here. So it reported after the bell yesterday. It was a beat and raise quarter. They also boosted their profit and revenue guidance for the full year, that is. Wall Street analysts really psyched about that in particular. And you saw Synopsys shares close about 10.3% higher. It was also a big day for Lucid in particular, up 11% on the nose. That's after Bloomberg News reported that Saudi Arabia, it's looking to join forces with the EV startup. It's part of the kingdom's ambitions to roll out about 300,000 cars by the end of the decade. The auto industry, a key focus for the nation when it comes to diversifying away from oil. And finally, DocuSign, I wanted to end on this, but there wasn't a lot of news here. I'm going to be completely honest, but it might just be part of that sort of broader speculative rally that we still saw, even as some of the big benchmark indexes gave up those gains. But I do want to point out, even though DocuSign, you saw a lift of about 7.5% today, it's still down almost 50% for the year, Tim.
Yeah, it has not been pretty with DocuSign. Let's talk Cisco in terms of decliners. Finishing the day down more than 13% today, Taylor. It's falling the most in more than a decade. This after the company warned that lockdowns in China as well as other supply disruptions would wipe out sales growth in the current quarter. If investors are looking for some sort of silver lining here, it's that it could have been worse because Wall Street was wondering if the company's forecast meant that customers were cutting spending, but Cisco said supply woes, that was the main issue. It's now trading at levels last seen in November of 2020. Also, Under Armour finishing the day down by about 12%. Shares falling after the company said that the CEO, Patrick Frisk, is stepping down after just 2 years at the company. Colin Brown, the COO, is set to become interim CEO as the board kicks off its search. And then HOG, probably my favorite ticker, Harley Davidson, finishing the day down by 9.3%. It plunged after the company said it would halt almost all assembly and shipments for 2 weeks because of a, quote, regulatory compliance matter with a part from one of its suppliers. It's just the latest in a series of challenges for Harley Davidson.
Tim, we're going to think about some of the consumer, and we're going to bring you some quarterly results here from Ross Stores, tumbling about 12% or so in the aftermarket. I want to run you through some of the numbers. So first quarter EPS coming in a little bit light, 97 cents versus estimates of $1. Looking at second quarter comp sales, -4% to -6%. The Street was looking for a gain of 2.5%. Full year comp sales, -2% to -4%. They had seen flat to up 3%. First quarter operating margin flat, but again, that forward guidance, when you think about second quarter EPS, 99 cents to $1.07. The Street was looking for $1.32. So you're really cutting big guidance all the way down on the bottom line. Full year now EPS of $4.34 to $4.58. The guide had been as much as $5. So really seeing here, I think the CEO comment here says it all, Shanali. We are disappointed with our lower than expected first quarter results. We had a really strong start to the year. We have a really good balance sheet. And then all of this starts to unwind when we think about some of the lockdowns and the supply chain issues.
And you see these numbers come together and you wonder how Wall Street has it so wrong with the estimates that have come out. Should there have been more guidance moving into these types of results? Margins under pressure yet again, Taylor, for another quarter.
Yeah, inflationary concerns. I want to continue with what Taylor was talking about. The company's CEO, Barbara Rentler, is saying that we knew fiscal 2022 would be difficult to predict, especially the first half when we were facing last year's record levels of government stimulus and significant customer pent-up demand as COVID restrictions eased. And here's where it gets interesting, guys. She says the external environment has also proven extremely challenging as the Russia-Ukraine conflict has exacerbated inflationary pressures on the consumer not seen in 40 years. So add Ross Stores to the list of companies this week talking about inflationary concerns in a way that they did not expect, i.e. Walmart, i.e. Target.
And we also have earnings coming from VF Corp. So if you look at fourth quarter revenue, oh man, it was just basically there, 2.82 billion. That was versus estimates of 2.83 billion. The adjusted EPS it was about 45 cents. Estimate was for 46 cents. If we look at how shares are performing after hours, basically unchanged, a touch later, down about 0.4% after hours as traders really parse those results from VF Corp.
This is relentless, though. Kohl's, Bath & Body Works, Under Armour, executives leaving, profit being hit. This is a picture of, well, a company having to take on the hit rather than a consumer. At what point do they think that they can pass on those inflationary pressures? At what point can the consumer withstand it? And who are the tales of the haves and the have-nots? Is it the luxury that outperforms and really the more priced for the lower income household, the one that really has to stomach some of this pain? Really, I'm amazed after a $1.5 trillion rout yesterday, we couldn't muster any sort of gains on a broad-based benchmark basis.
I think really interesting that we spoke with Anastasia Amoroso over at iCapital, and she said that unfortunately this might just be what the Fed wanted to see, that people are realizing that the consumer can't handle this, the consumer gets cautious, the consumer pulls back, and that helps ease and at least tighten some of the financial conditions, do a lot of the work for the Fed for it. Shelley, those were some interesting comments.
Yeah, and on top of that too, we spoke to BMO's Carol Schleif, who also talked about the fact that these companies, the ones that want to see it through this downturn, if you will, the slowing growth environment, will not raise their prices for clients because they're going to want to make it through the end and have more clients there for the market share gains.
It's
Can you
that
see
choice.
through the pain, though?
Yeah, but Shonali, it's that choice to not raise prices. And that's what we saw from some of the big retailers earlier in the week, Target, Walmart. So far, it's a choice that they want to rather sacrifice some of their margins and protect their prices. We'll see how long they can continue to be able to do that before they actually do have to actually raise those prices.
And the ADP number, I guess, coming in interesting. I mean, overall, the fact that the bad news wasn't good news, it was a little bit at the start of trade, but the fact that we got some slightly more cautious data when it comes on the Philly Fed as well, all of this just painting a story of how much we can see the Federal Reserve stay as hawkish as it has been.
Yeah, our coverage certainly continues, and we are going to get a lot to dig into, not just in the next hour as we close out our programs, but also tomorrow as we wrap up what has been a really volatile week. That is going to do it for our cross-platform coverage of the market close here on Bloomberg Television, Radio, and YouTube. We will be back tomorrow at the same time and place.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld. We're live in the Bloomberg Interactive Brokers Studios in New York. Katie, I want to just recap what we're seeing with Ross. Shares are lower in the after hours by double digits right now. The company's second quarter earnings per share forecast missing estimates. The company's CEO saying that inflationary pressure as a result of the war in Ukraine is leading to challenges, of course, with the consumer.
And really quickly, VF Corp actually higher after hours. That revenue was pretty much just on the screws.
Well, let's get an update on world and national news. For that, we go from New York City to Washington, D.C., where we find Nancy Lyons with an update. Hey, Nance.
Thanks, Tim. President Biden says Finland and Sweden have the full backing of the U.S. in their bids to join NATO, even in the face of opposition from Turkey. Bloomberg's Washington correspondent Anne-Marie Hordern says Biden met with the leaders of both nations today at the White House.
It's incredibly historic. I mean, if you started the year saying you think that you're going to have Sweden and Finland join NATO, most people would say you were crazy. This completely reshapes the post-Cold War security alliance in Europe.
Bloomberg's Anne-Marie Hordern. Biden is now on a 6-day trip to Asia. FDA Commissioner Dr. Robert Califf took plenty of questions today on the baby formula shortage when he appeared before the House Appropriations Committee.
Dr. Califf, who took the job in mid-February, was asked why it took 4 months for a whistleblower complaint about the Abbott factory for the FDA to act. He said only that it's being investigated, so he discussed getting the plant restarted.
When we have a concentrated industry where taking down one plant has such an enormous impact. And so we had to really wrestle this to the ground with Abbott to make sure that as we bring the plant up, both the FDA and external experts are watching every step of the way.
Dr. Califf also said the FDA's Food Inspection Division needs more staff, and experienced former employees are ready to return. In Washington, Irv Chapman, Bloomberg Radio.
This just in, CDC advisors have given approval of Pfizer booster shots for kids 5 to 11. At the PGA Championship at Southern Hills Country Club in Tulsa, Rory McIlroy leads the pack with 5 under. Tiger Woods is tied for 113th at 4 over. Stay tuned to Bloomberg for hourly golf updates and full play-by-play coming up after the markets close here on Bloomberg Radio. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
Thank you so much for that update, Nancy Lyons, Tim Stenovic, and Katie Greifeld live in the Bloomberg Interactive Brokers Studio in New York. Katie, this story getting my attention because it was written by our very good friend, Vildana Heinrich.
The best. Cream of the crop.
She's great. And it also is among the most read on the Bloomberg terminal. It's about consumer psychology. So to the extent that there's a pullback, it's a ripple, but when stocks are down like this, it can weigh on sentiment. Exactly what we were talking about.
It's all about the wealth effect, really.
Yeah.
That, you know, Americans have felt so much richer even amid the pandemic and the recession that we had because of the pandemic, because of the stock gains.
Stock gains, rising equity in their homes as well.
Absolutely.
As those values have gone up. It's been massive.
It's been massive. There's a great quote in here. She spoke to Jim Paulson, chief investment strategist at Luthold Group. He said that everything you had on your balance sheet went up by so much for so long. I don't care if it was a stock, a bond, a commodity, a rare art, I mean everything. So to the extent there's a pullback, it's a ripple.
So he's saying, chill out. Okay? Because Katie, I mean, you told me that stocks only go up.
Stocks, I mean, that's been, in the grand scope of life, surely stocks will go up. I mean, that's what everyone would tell you.
You're not giving investment advice.
No, I'm not. I'm just telling you what people have told me. And you talk to any financial advisor on the street, they'll tell you stay invested. Don't look at your portfolio. It's going to be fine over your time frame, but it looks really painful right now.
Yelena Shulyaitova, who we have on our air quite a bit, she's at Bloomberg Economics. She notes that wealth effects work with a lag, and much of the market's volatility has yet to actually land on sentiment. She uses a model that adds real estate to the psychological mix. Home price gains slowed to 12% in the first quarter, and if that were to be annualized, she estimates that stocks would have to drop 30%, Katie, from their peak to wipe out the wealth effect from housing. So if home price gains slow further to 5%, the drawdown in stocks would already be large enough to scotch sentiment. Yeah. What do you think?
That sounds bad.
Yeah, it's all about sentiment and the way that we're spending our money because of how we're feeling. Check this story out on the Bloomberg. This is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
With a headline from the Bloomberg Professional Service and DoorDash buying back up to $400 million in shares to offset employee grants. Earnings news. We heard from Applied Materials, that is the semiconductor capital equipment company. It reported second quarter results that missed expectations. It also gave a forecast that is below the analyst consensus. After hours, shares of Applied Materials down by about 5%. Ross Stores forecast earnings per share for the second quarter. That guidance did miss the average analyst estimate after ours. Ross down by almost 18%. The Dow, the S&P, NASDAQ all declined today. We saw the S&P 500 index tumble 22 points. A choppy session today. The S&P was down 0.6%. The Dow Jones Industrial Average down another 236 points today, down by about 0.8%. NASDAQ down 29, a drop there of 0.3%. A volatile session as investors weighed prospects for growth against a backdrop of rising prices and tightening monetary policy. 10-year up 9/30, 10-year yield 2.84%. Spot gold up 1.4%, $18.41 the ounce. West Texas Intermediate crude up 1.6%, $111.40 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, fintech is attracting significant VC funding in recent years as we've seen consumer-facing companies like Chime and other fintechs and challenger banks take on the existing financial system. But what about when it comes to B2B solutions? Well, enter Evio. It's a fintech focused on e-commerce technology. Adrian Jones is the co-founder of Evio. Adrian joins us now on the phone from New York City. How are you, Adrian?
I'm very well and delighted to join you today.
It's good to have you with us. What was the area missing when it came to like the white space that you saw with the development of Evio? What was the problem that wasn't being solved?
I think the key issue that we saw is that payment systems and ways of moving value around within e-commerce networks, what was being implemented was really a set of solutions that were originally created for a sort of former world, which was the merchant to consumer world. And as we move into the e-commerce world, we're seeing far more person-to-person commerce, and we're seeing small business commerce as well. So it's a way of enabling that type of commerce to take place without the necessity of going out to the third-party payment networks, where you always involve fees and transaction fees and also separate logins and separate requirement to, if you like, interrupt the completion of a transaction. And we've all experienced when you try to engage in a transaction and just the additional information you have to add.
What about a company like Venmo that does offer peer-to-peer payment technology? Does that solve the problem, or how do you think about that?
I think that there are lots of great solutions for specific problems, but when you're looking at e-commerce generally, we're looking at how do you operate across multiple countries, how do you operate across multiple currencies and forms of value, and then how do you integrate that actually into the e-commerce transactions so that you're not having to go through a separate login, a separate payment processing.
And Adrian, tell us about... Yeah, sorry, I was just going to say, tell us about fluid commerce and how that fits into this conversation, that recent launch.
Yeah, so we've recently launched Fluid Commerce, which put simply is a way to earn and spend within an e-commerce network. So without requiring a credit card or a bank account, it's a way of enabling you to generate funds in any form of value. It can be fiat currencies such as dollars or euros, or it could be indeed tokens or crypto value. And it's a way of enabling you to earn and spend without going outside of the network. So it makes those one-tap transactions instant and immediate.
And who do you see as the typical user of fluid commerce?
So ultimately the users, fluid commerce will be implemented into social commerce networks, sharing economy marketplaces, metaverses, super apps, gaming networks, so places where people can both earn and spend within the network. So this is not just about one-way commerce. This is about two-way commerce where you have the opportunity to earn and to spend.
Katie, he said metaverse.
He did say metaverse. Does that mean the metaverse exists already, or is this sort of a long-term vision that you have?
Well, we see that, I mean, ultimately what we tend to talk about as the metaverse, of course, will start as many metaverses, and it's really this concept of next generation augmented reality, virtual reality-based commerce, and really where you get to is any type of transaction that can take place in the real world going forward can take place in a virtual world. So we see that there will be earning and spending within virtual worlds exactly the same as there are in the real world today, and yet there's not really a suitable payment solution for that as yet. And
Adrian,
that's really one of the things we've worked on.
How do you make money at Evio?
Very simple, by licensing our patented technologies. So this is really an infrastructure set of technologies. This is not about taking transaction fees. It's a licensing and technology base for enabling greatly expanded revenue within e-commerce networks.
And so you mentioned that, there's not yet really a payment system that exists from the metaverse. And if you think about, fiat payment systems, I guess from your standpoint, from Evio's standpoint, that's about taking market share away, whereas the metaverse, it would be, the pie, no one's really claimed it yet.
No, and I think ultimately you have to have a solution which goes from the fiat currency world of today to a world that fully embraces other forms of payment. And that's why we recently announced a partnership with Veet Labs, which is a fee-free transaction blockchain company. And we really see that future forms of payment will be multi-chain. Those need to be supported, and it's not for us to bet on which one which ones are the winners. We see that we'll be in a multi-chain world. We'll have a combination of fiat, token, and digital currencies in use, and we need to be supporting all of them, earning and spending in each.
Adrian, how do you look at, in just in the last 30 seconds that we have with you, how do you look at a company like Meta Platforms, the owner of Facebook, that's increasingly trying to move into the metaverse, but also develop its own payment system? Does that seem decentralized to you?
Well, until we see finally what they launch, we don't know. But certainly what we see is that the aspect of earning and spending that is underpinned by our patents is something that we feel we're very well positioned to do. And companies like Meta and others are potential business partners for us.
All right, well, there you have it. Adrian Jones, the co-founder of the fintech Evio, joining us live from New York City. It's a fintech company. It's focused on the next generation of e-commerce technology. You're listening to a Bloomberg Business Week from Bloomberg Radio, and this is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stenivek and Katie Greifeld. We are live on this Thursday in the Bloomberg Interactive Broker Studios in New York. Katie, you've heard about the Great Resignation, right?
I've heard about it, yeah.
What about the Great Reboot?
You know, I haven't heard of that one too much.
All right, that's what we're going to be talking about in just a few minutes. That's all the tease I'm going to give when we are joined by our next guest. First, though, Charlie Pellet has been keeping an eye on the markets after hours. A lot of earnings, Charlie.
Indeed, plenty of earnings. We had Applied Materials, that is the biggest maker of machinery used to manufacture semiconductors, tumbling more than 4% in late trading after persistent chip shortages weighed on its forecast for the current quarter. Applied Materials down, but an even bigger mover out of Ross Stores. It is falling now by roughly 18% after the discount retailer cut its outlook for profit and sales. Target, by the way, down another 5.1% today. Yesterday, Target plunged 24.9%. So what is it that has been sending retailers lower? Kathy Entwistle is a managing director at Morgan Stanley, and she was interviewed right here on Bloomberg Business Week.
A lot of unknowns that are hitting their bottom line, which includes rising interest rates, which would mean that the cost of borrowing has gone up, supply chain issues. And it's a question of, are they going to pass this off to the consumer, or are they going to take the hit in their own bottom line? And I think they have to take the hit in their own bottom line for the most part, because the consumer is not willing to pay those dollars anymore.
Arconic Corp says it will sell its Russian operations, joining the exodus of American companies after the invasion of Ukraine, which said it was impossible to do business, or at least it said it made doing business in the region untenable. The Pittsburgh-based aluminum sheet manufacturer expects to record a charge of as much as $500 million relating to the move. Stocks lower. S&P today down 0.6%. The Dow down another 0.8%. NASDAQ down 29, dropping by 0.3%. 10-year yield 2.84%. Spot gold up 1.4%, 18.41 the ounce. West Texas Intermediate crude up 1.8%, 111.51 a barrel. I'm Charlie Pellet. That's a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, as I mentioned, we've all heard about the so-called Great Resignation, but what about the Great Reboot? Our next guest argues that now is the time for leaders to rethink or reboot the models that they have come to know. He's the author of a dozen books. His latest is A New Way to Think, Your Guide to Superior Management Effectiveness. It's really our pleasure to have Roger Martin, Professor Emeritus at University of Toronto's Rotman School of Management, joining us via Zoom from Fort Lauderdale, Florida. How are you?
I'm doing great, Tim. Thanks for having me.
Yeah, it's really, really good to have you. So let's talk a little bit about these last couple of years. At what moment did you realize that because of this new normal, this new environment that business leaders are in, they really need to change the way that they're thinking and throw out these previous models?
I think what it just did is accelerate my feelings of that. I guess I've been feeling that for a long while, that many business models that have been in use for a while just don't really work. And I think the pandemic maybe helped some managers say, maybe now is the time to rethink.
And tell us, yeah.
And I was going to say, and a good example is what you said in the lead-in, the Great Resignation, right? The Great Resignation, I believe, is based on a business model that has to change, which is that people make decisions on the basis of loyalty, and they don't. They make it on the basis, to a greater extent, of habit, right? And so it turns out that the subconscious kind of likes comfort and familiarity more than anything else. And so you less so have a Tide detergent loyalty than you have a Tide habit or a Colgate toothpaste habit versus loyalty. And so when the Great Resignation, when the COVID hit, right, everybody got told by their employers, you have to break a habit. We're forcing you to break a habit, which is coming to the office to work, and you got to work at home.
Mm-hmm.
But after 2 years, right, that was the new habit.
Right.
And so when workers were asked, you must come back to work. For them, that's the new remotely, right? That's working remote. Home is your office. That's working remote. And lots of people are doing what they do when their habit is broken, which is that the what they're doing today, right, wins out over the potential new thing. And companies are not getting that because they think, well, they're going to come back. They're loyal. It's a conscious decision. It's not.
And I do think about that all the time, that really working from home for a lot of people, that is their new normal. It's not, it's for 2 years that a lot of people have been living that, and new families have been formed in that time. But if you think about these models that you're talking about, I don't know, just today, earlier on this program, we were talking about Ken Griffin saying that, you know, basically chiming the bell again that people should return to the office. It feels like the model's still in a lot of corporate America at the C-suite level are saying still their model is working in the office.
Yeah, and I'm not adverse to working in the office, but all I'd say is if these executives kind of really understood what's going on, they'd say, I have to slowly but surely build a brand new habit, which is called working at the office. Not, I can suddenly order it and have everybody change and say, oh, I'm going to stop doing the thing that I've gotten totally comfortable with over the last 2 years and take this this new thing. Like if you have a habit for something and it's going against other competitors, it's literally like you're doing a 100-yard dash, and whatever habit is gets to start when the starting gun fires at the 80-yard line. And all the rest of the options start at the starting line. And who's going to win that race, right? Habit. When you say, as a company, I'm going to stop your habit and ask you to consider this job, which is an entirely new job for you, coming to the office and doing something different. That job goes back to the starting line with, I'm going to become a gig economy person. I'm going to work for somebody else who doesn't say, I'm going to go back to the office. And you're all now at the starting line, and it's a fair race. And it is baffling to me, like it's utterly baffling to me that all these executives somehow think that they have an advantage of that person being their employee, and they'll agree to come to the office.
We're speaking with Roger Martin, Professor Emeritus at the University of Toronto's Rotman School of Management. He's also the author of the new book, A New Way to Think, Your Guide to Superior Management Effectiveness. Roger, stick with us because we're going to take a quick break, and then we're going to come back with more. What I'm really interested in talking about, Katie, is this idea of putting customers before shareholders. We're going to dig into that right after the break. You're listening to Bloomberg Business Week. First, let's get a check of the latest world and national news. Nancy Lyons is standing by in Washington, D.C. Hey, Nance.
Hey, Tim. President Biden is cheering the bids by Finland and Sweden to join NATO.
Today, I'm proud to welcome and offer the strong support of the United States for the applications of two great democracies.
Biden hosted the leaders of the two nations today at the White House. He says they both meet the requirements for membership in NATO, and then some. But in order for all this to happen, the U.S. and the two prospective members will need to convince a reluctant Turkey that believes both nations support Kurdish militias. The Senate passed a $40 billion Ukraine aid bill today. Ahead of the vote, Senate Republican leader Mitch McConnell expressed his support for the measure.
Anyone concerned about the cost of supporting a Ukrainian victory should consider the much larger cost should Ukraine lose.
McConnell is one of 86 yes votes. There were 11 nays, mostly Republicans who expressed concerns about raising the deficit. Oklahoma lawmakers have passed a bill that would ban nearly all abortions beginning at fertilization. If signed into law, it would be the most restrictive abortion law in the country. The man accused in the mass shooting at a Buffalo grocery store has been indicted by a grand jury and appeared in court today to be charged with first-degree murder. Peyton Gendron allegedly killed 10 people at the Tops grocery store. At the PGA Championship at Southern Hills Country Club in Tulsa, Oklahoma, Rory McIlroy leads at 5 under par. Tiger Woods is at 123rd place at 4 over. Stay tuned to Bloomberg for hourly golf updates. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much for that update, Nancy Lyons. Tim Stenovic and Katie Greifeld. We're live in the Bloomberg Interactive Brokers studio in New York. Katie, you and I co-anchor Quick Take Stock each day.
Every day.
At noon Eastern Time on Bloomberg Quick Take. Just before our show ended, Mark Gurman publishes this scoop about Apple. And we know when it's a Mark Gurman scoop, it's going to be a good one.
He is unstoppable,
He
that
is.
guy, that Mark Gurman.
I mean, it's not a joke. He is
No,
like,
it's not.
He is the Apple reporter.
guy.
Yeah. It's. I know I'm biased, but even when I was at competing news organizations, it was like,
Wow.
try to keep up with Mark. Anyway, enough about that. Let's get to the news here. Apple executives previewed its upcoming mixed reality headset to the company's board last week, indicating that development of the device has reached an advanced stage. That's according to people familiar with the matter. Okay, so the company's board, it's made up of Tim Cook, the CEO of Apple, 8 independent directors as well. It convenes at least 4 times a year. A version of the device was demonstrated to the directors during the latest gathering, said the people who asked not to be identified because the meeting was private.
And we've also learned that Apple, it's really ramped up its development of ROS, its reality operating system. So if you couple that progress with the board presentation of the headset, Mark Wright said this product's debut could come potentially within the next several months, Tim.
This is a really, really big deal. When you think about new product categories for Apple, the last one that it had that was new was all the way back in 2015. That was the Apple Watch. Before that, it was the iPad. And before that, it was the iPhone. So when you think about product categories for Apple, this is a very big deal.
It still could be, a way off. So Apple is aimed to unveil the headset as early as the end of this year or sometime next year, a commercial release planned for 2023. It had targeted an introduction at the Worldwide Developers Conference in June, but challenges related to content and overheating led to potential delays, Tim.
Yeah, here's the thing. Apple's not really ever the first to create a new category. They're not the first to come out with a smartphone. They weren't the first to come out with a tablet, but oftentimes it's the best one, and it's the one that consumers find the easiest to use. Keep it here. You're listening to Bloomberg Business Week on Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Shares of Ross Stores plunging after hours. After earnings, the discount retailer has cut its outlook for profit and sales. Ross now down by 21%. Also after the bell, we heard from Applied Materials. It's the biggest maker of machinery used to manufacture semiconductors. Applied Materials down just about 1% in late trading after persistent chip shortages weighed on its forecast for the current quarter. A down day on Wall Street, volatile session. Investors are weighing prospects for growth against a backdrop of rising prices and tightening monetary policy. The S&P was down 22 points today, down 0.6%. The Dow down 236, down by about 0.8%. Nasdaq down 29, a drop there of 0.3%. 10-year up 12.30 seconds, 10-year yield 2.83%. Spot gold up $25 the ounce to $18.41, up 1.4%. And West Texas Intermediate crude up 1.7%, $111.40 a barrel. Briefly, the NASDAQ 100 index down 0.4%. Russell 2000 did eke out a gain today of just about 0.1%. So a down day on Wall Street. S&P down 0.6. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. I want to get right back to Roger Martin, Professor Emeritus at the University of Toronto's Rotman School of Management. Roger joining us once again on the phone from Fort Lauderdale, Florida. Roger, as promised before the break, I wanted to get into stakeholders here because I think, you know, there's the view that stuff stakeholder capitalism, and we could talk about that. But what I want to talk about is you argue that the focus on shareholders isn't really the right focus here. That instead of focusing on shareholders, companies should focus on customers, because if a company succeeds in satisfying its customers, then the shareholders will be taken care of. It's basic. It makes sense.
I think so,
but why is it? I mean, why is something like this? Why is something like this seem so revolutionary, right? I mean, because it's not putting it's not putting the shareholder first.
Yeah, it's because these models of how the world should work get very ingrained, right? It was the mid-'70s. An influential article came out in 1976 that said, senior management has to have stock-based incentive compensation so that they put shareholders first, and then shareholders will do better. And you can say, okay, fair enough. We might argue about whether we care about shareholders or not, but let's just imagine we do. Let's look and see if after that change in a model that said shareholders must come first, that shareholders have done better, right? And the answer is they haven't, right? So you'd kind of say, this is 46 years and counting. We're getting near to half a century. Shouldn't you think about why it might not be working as well as you'd think it would? Because it sort of makes some sense. They kind of own the companies, so put them first. Well, no. If you say to everybody involved, we're here to create shareholder value, shareholders come first. Well, how motivational is that to customers? Kind of not very. They feel like they've got a target on their back. How about to employees? Who rolls out of the bed? Tim, do you roll out of the bed every morning and say, gosh darn it, I'm so happy I'm going to work to increase shareholder value? I don't think so.
I think you have to say yes, Tim.
Yeah.
Sorry. I shouldn't have asked you that on air.
What I do think about, and it kind of goes back to the idea of what Jeff Bezos has talked about a long time, is serving customers. And, I think about it from the perspective of, okay, my customers is our audience. It's Bloomberg customers, it's listeners around the world who are viewing us on YouTube, it's listeners around the country listening to us on Sirius XM. So what is the best way I can serve them? By interviewing people like you. So, I guess it makes sense from that perspective. But again, it's like, something has been lost in the last 45, 50 years when it comes to where executives need to be focused.
Absolutely, and it's the problem is with models, like in just plain stupid illogical models never get ensconced, but ones that seem to make some sense on their face, those are the dangerous ones, right? And we'll align the interests of management and shareholders with stock-based compensation. That sounds, if shareholders win, executives will win. That sounds seductively sensible, but it just doesn't work, right? It actually causes executives to do things in the short term that actually hurt shareholders in the longer term. So you've got to. What I'd say to every manager is, when you have a seductively simple model that doesn't seem to be working, you got to ask yourself the question: is there a better model? And I think Jeff Bezos has got a better model. Right? We're just, if we serve customers really well, other things will take care of themselves. It's like, the great Greek philosopher said if a person sets out in life to be happy, they're probably not going to end up happy. If a person sets out to lead a good life, a life of servitude to others, they're probably going to end up happy. It's the same way with shareholders.
Well, in thinking about models, and like you said, a simple question that one should be asking themselves: is there a better model for me? Does anyone, or do any C-suite executives organically come across that, or does there need to be some sort of breaking point, some sort of exogenous shock that sort of forces them to ask that question?
I think that sometimes does it, Katie, for sure. But there are executives, and I know, fortunately, a number of them who I think get to where they get to in life by being better consumers of models. They'll ask, I worked for many years with A.G. Lafley and wrote a book with him, the famous Procter & Gamble CEO. And he would often just ask at management meetings, that sort of freak people out a little bit and say, is this really the best way we could be doing this? And everybody's like, whoa, wait a minute, you're going to throw out how we've been doing whatever this this in the sentence was. But he always just wanted to not rest on a given model, and he wanted that model. Like I remember when he said, it's the way we handle trade terms with our retailers, right? He just wanted to make sure it was constantly being tested so that it either worked and could continue in operation, or it didn't work, and then the job was to create a new one. And I think that's just better managerial practice. Some, like Steve Jobs and Jeff Bezos, that seem to have just been born that way, and they don't need a crisis to do that. They were searching for ways to do things differently.
Roger, we only have 1 minute left. I'm wondering, as companies look out and at the landscape right now and struggle with how to navigate it right now with high inflation, difficulty attracting and retaining talent, what's one company that's doing this really well, that's shifting its mindset very well?
I would say a company that's got a great mindset that I really like is Four Seasons Hotels. Right, they've got a talent strategy that's just different than everybody else in the industry, pretty much, and they've been on top of that industry for a long time. And they do things like when the tsunami wiped out all the hotels in the Maldives, including their 2 hotels, rather than saying we're going to lay off our employees, and then when we rebuild the hotel, we'll bring them back. They said, here's what we're going to do. We're going to offer them a job anywhere in the world in the Four Seasons hotel chain, so that we'll have them there when we open the hotel. And the loyalty of employees that go through that is just like off the charts. You could say, oh, wouldn't shareholders perhaps, be hurt by having these excess employees working at other hotels? No.
Roger Martin, we're going to have to leave it there. Roger is Professor Emeritus at the University of Toronto's Rotman School of Management. His new book, A New Way to Think, Your Guide to Superior Management Effectiveness. That is going to do it for Bloomberg Business Week on this Thursday. Have a great evening, everyone. This is Bloomberg.